Hello and welcome to our discussion on preparation of financial statement. We are in lecture number 8. We are going to continue our discussion on the bad debts and the provision for doubtful debts. We saw that bad debt is a loss due to insolvency of the debtor. Debtors will reduce to the extent of the bad debt, and bad debt will be shown in the income statement as a loss. But sometime when I'm expecting a bad debt in future, you are allowed to create provision for doubtful debts because of the conservative convention, and the provisions are created on the debtors, and the provisions are charged against the income for the year, and provisions can be shown on the balance sheet as a reduction from the debtor, or on the sources side, maybe under the current liability. The focus of this session is to understand the additional provision. If there is an additional provision, that means already provision was there. You wanted to create a provision further on the current sales, then you end up with a higher closing provision on the balance sheet. Let us go to the exercise. In the previous session, we saw that the business created a 20% provision on the debtor, and provision is shown on the balance sheet, but provision is also shown in the income statement, and debtors are not reduced to that extent. So suppose we treat this as an year 1, and let us assume that this balance sheet of year 1 is transferred to the next year. Okay, the same balance sheet with the same items, and suppose these are the transactions for the year 2. And you see that once again you're creating additional provision of 20%. So let us continue. So you're availing loan of 12%, 12% loan of 1,000. So before we show the loan, let us show the opening cash, and the loan is a receipt that is 1,000, and loan is a source that is 1,000. You purchase stock for 500 for cash, so therefore I'll say stock you purchase for 500, okay, and stock was there 340. Now stock is 500 plus 500, so stock will increase on the balance sheet, no expense as of now. You paid money for that, and then you sold entire stock for 2,000, no cash because it is on credit, so the debtors will increase by 9 from 9,000 to 2,900. And whenever there is a sale, because of the matching concept, the COGS has to be shown in the income statement. So COGS will reduce the stock to the extent of the goods sold, and here entire stock is sold, so stock will become 0. As usual, because of accrual and matching principle, expense will be shown in the income statement, and if you pay that expense, which is what happened here, so expense will appear as a cash flow. Since the expense is equal to payment, no asset or a liability. But here you see you're creating a provision, so therefore let us go to an working statement. So working sheet, you had an opening provision, you're creating 20% provision on the current sales, that to credit sale. So current provision is 400, and this provision is added to the opening provision, so therefore the closing provision will be 180 plus the current provision is 580. So let us put one more item, that is interest. Okay, interest is an expense because of accrual concept, so into 12, okay, 0.12. So profit before tax is equal to the sales minus 1840 minus 250 minus 400 minus 120. Okay, so profit before tax is 390, and let us assume that interest has been paid, so therefore entire interest is an outflow of cash. Similarly, let us assume that 390 is also the taxable income, so tax is a payment, no outstanding anymore, so entire tax is paid off. And we continue with our assumption that the entire profit is retained, so 273 will be added to the retained profit of the current year in the balance sheet. Then we'll show the cash in hand. Cash in hand will be the cash receipt minus the cash payment minus the cash payment, so the cash will be 1031. Okay, so cash in hand is 44. Cash in hand is 44. So cash in hand will appear on the balance sheet on the asset side. No change during the year on the capital, so the capital remains, no buyback, no further issue, no bonus issue, so therefore the capital is same. Now the focus of this particular presentation was the provision for bad and doubtful debts. No bad debt, so the bad debt, or since there is no bad debt but the company expects there will be a possibility of bad debt in future, so they're creating 20% provisions once again for the current sale, so that is 20% on the sales, and that is shown on the income statement and charged against the income for the period. So provision increases and the debtors increases to the extent of the current sales. So if there is a bad debt, we saw that bad debt is shown on the income statement as a loss, but if you expect the provision or expect that in future there will be bad debt, create a provision, and provision continues to appear as long as you are not writing off the bad debt. So later on we'll see that if there is a bad debt, what will be the treatment of provision on the balance sheet, income statement and cash flow statement. Thank you.